All right, let's talk about cheap options. And more importantly, the chart I have on the screen right now, this is a chart of the VXX. This is the iPath S&P 500 VIX futures ETF. It's very similar to VIX, but it actually looks out into the future and looks at VIX at the futures markets. And what it is telling me is that all of that huge pullback move we've seen so far, the high happened in April when the stock market crashed, the VIX went up. Right, the stock market has regained its value and moved higher and moved to all-time highs. And what has the VIX, what has the volatility index done? It has gone lower. Hence the adage, when the VIX is high, it's time to buy. And that was the time to be buying the overall market. When the VIX is low, what does that tell us? The VIX is low, it's time to go. What does go mean? Go means start to protect any profits you have. Start thinking about the fact that this market could see a pullback. That's what the VIX is telling us right now. And seasonality is telling us the same thing. So when the VIX is low, you know what else it tells me? It tells me that in the overall scheme of the markets, options are relatively cheap. How do we know this? Because what we do is we take a look, and I have a half a dozen different option scans I do. I look at everything from options that have high volume to options that have high open interest. That means there's the people that are actively involved in those specific contracts. I look for unusual call volume. What I look for there is I'll look at call options and the volume today versus what it has been doing over the last 30, 60, 90 days. Same thing with puts. And then finally, what I also like to look at are cheap and expensive IV options. Now, what is considered cheap and what is considered expensive? We'll talk about the cheap options IV today. I'll look at the expensive ones in a future broadcast. What we do with, how do we determine if options are cheap? Is it because of the price? No, because if that was the case, Tesla would always have an expensive option, all right? And something that's less than $10 a share would always have the cheapest options. No, what we do is we look at the options for Tesla or the options for the $10 stock, and we look at those over the course of at least a year. And we see what those option premiums were trading at over the course of a year for that stock. And we can determine where they traded out that was the most expensive, where they traded at the most cheapest, and we're able to actually connect the dots and create a chart of that implied volatility. Hey, I'm Tom Gentile, America's Pattern Trader, and markets get rocky this time of the year. But this isn't my first rodeo, but the money counter is still delivering stock patterns with a 90% or better probability of profit, even in September, one of the bearish months in the market. Hey, get the patterns, the trades, and my playbook for just $9. It's kind of like the weather. You know, someone could say, oh, it's hot this time of year. Depends on where you are. If you're in Antarctica, it's not hot, okay? So it's best to say, well, how hot is it in Florida? And what's the record high and what's the record low today? And then we get an idea of where we are in terms of the all-time highs and lows, or even over the last year. We know it's hot in Florida in August and September, probably the hottest months on record. But then for Florida, you've got, a high heat temperature to begin with. But if you are up in New York, you'll see the highs and lows are more substantial. We do the same thing with options. So what I do is I look at ranking these options, and I rank all optionable stocks. And what I do is I'll take the rank of those stocks or ETFs of the last year, and I compare what was the high in the last year, what was the low in the last year, where are we today? On the screen is the top 10 cheapest options by ranking their highs, their lows, and where they are today. And I said Tesla because of a reason. Tesla is the number one cheapest optionable stock coming into today. What I want to do with you is I want to take you through snapping as many of these as possible. We'll look at a few, the big ones, and see their highs, their lows, and where they are today, and what you can do about this. So from here, I'm going to actually move over into where my data is all hiding in my software. And here is Tesla, and there's Tesla's high is 105. That's the volatility, the implied volatility, 105. The lowest 45.33, and the last is 45.33. And if you look at this top 10 list, they all have something in common. Their last is equal to their low. All of these top 10 are top 10 cheapest, and they're all cheapest to themselves. So let's take a look at Tesla first. I'm going to click on TSLA, and you're going to see, at least over the last 6 months, where is it at right now? It's right down there at the bottom. This is just a 6-month chart, or maybe a 5-month chart. This is not even showing you the entire year, but you can see here it's gotten cheap. What's interesting is Tesla has traded between 280 and 360 and has literally gone sideways since May. And what has the implied volatility done? It has gone down in value. Now, we don't have earnings for another 65 days for Tesla, but the options are getting cheaper as we speak. Okay. How about the next one? Let's take a look at Pfizer, PFE. So Pfizer, too, has had a high, a low, and the last is near its low. Take a look at the high on Pfizer just on this chart and where the stock was. The stock was at 21. Stock has rallied all the way up to 21 to 26 is a pretty decent number. Had a little pullback here, but look what happened to implied volatility. As the stock went down, the IV went up, earnings came out, the stock recovered, and the volatility dropped even more. So here, Pfizer is sitting at just above $25 a share, but yet the volatility, which back in April was at 46, is now at 20. What does that mean? That means the options themselves, the time premium in the options, if you're looking at an average option, are going to be less than half of what they were in time premium when you compare them to April. Okay, let's look at a couple more. I'm going to come all the way down to SLV. This is silver. This is the silver ETF. Okay, the iShares Silver Trust. And you can see here with silver, silver's gone from back in April, it was just below $28. And then fast forward to middle of July, and it was at 36. Now it's kind of gotten in an area where it's between 33 and 36. It's actually at 34.57 right now. But again, what's happening to options on XLV? They were at a 36 implied volatility. They are down near 22, okay? And they've got a little bit bump up since this morning, but it's still showing that these are as cheap as they've been all year long. Last one I want to show you is I want to look at, well, we'll look at two more. Look at number 9 and 10. Number 9 is Meta. Meta had a high in the last year, 66, a low of 26.99, and it clocked in at 26.99 this morning. And since then, it has popped up a little bit, but look at the reason why. Meta has dropped. Meta has dropped off of the all-time highs just below 800. But if you look back in April, Meta was at $500. The implied volatility was up in the mid-50s, right? Meta has since gone up in value. Yeah, it popped up a little bit before its earnings, but its earnings were positive and stock recovered. Volatility dropped down into 20. So when you go from the mid-50s in volatility to something in the 20s, that is almost a 50% off sale going on with the time value of both calls and puts. Finally, DraftKings all the way down here at the bottom, right? DKNG. DKNG was a low 30 stock that became a high 40 stock, and it's still very close to a high 40 stock. Look at the options. The options were volatility was at 65 to 70. It's now at 30. It's in the high 30s. Again, here's another 40% off sale on calls and puts on DraftKings. So what do you do with the information that you see here? You know, as we move forward and as we're looking at those top tens, what do you do? Well, this is an area where if you are an option trader, right, then you like your odds on buying calls if you're bullish or buying puts if you're bearish, because now you're buying options that are on sale.